Hello, and welcome to part 2 of the Trader course with Forex.com. This is part 2 of our 6-part series, and today, we will talk about technical analysis. Your host, James Stanley, will be on the line momentarily to walk you through today's topic. But first, we must look at a disclaimer that will remain on the screen for 60 seconds. Upon the conclusion of the disclaimer, James will be here to begin today's discussion on technical analysis. Thank you for your time, and happy trading.
Hello, and welcome to part 2 of the Trader course. My name is James Stanley, and today we're going to talk about technical analysis. In our last installment, we discussed fundamental analysis. And like I said in the introduction there, technical analysis and fundamental analysis can fit really well together. You may see some sources claiming that one is objectively better than the other, but better is a very relative term. And in reality, neither is predictive. They're just different ways of looking at the problem of price projection. But importantly, while they are both forms of analysis that can be used to generate trade ideas, they are not mutually exclusive and can be used in tandem as each speaks to a different part of that problem. Fundamental analysis focuses on inputs that help to shape what happens, and this can be helpful for forecasting purposes. But forecasting does not mean prediction. And the point of that analysis is to try to form probabilities based on what's happening in economic data in order to anticipate what may then happen in price. Technical analysis, on the other hand, is focused almost entirely on the past because, after all, the price chart really is just a running record of what price has done. And logic dictates that the past does not predict the future, so the chart alone could be a difficult roadmap, as this would be like trying to operate a car by only looking in the rearview mirror. You're going to miss quite a bit without at least some respect of what's sitting ahead of you. But this isn't to mean that technical analysis is without value. After all, there's a reason that we learn history in school, right? So that we're not doomed to constantly repeat past failures in order for us to learn something from what's happened, so that maybe we're a little better equipped for what's ahead. But perhaps more to the point, if history doesn't repeat, it might rhyme. And this is where the price chart can help. If a market is and has been displaying a trend, there's probably a reason for it. And oftentimes that reason could be boiled back to something on the fundamental front. In our last presentation, we focused in on the dollar-yen move from 2021 and through the first 9 months of 2022. And that was an astounding trend. But it was happening for a couple of very important reasons, key of which was the continued posture from the Federal Reserve as the bank continued to hike rates. That trend was in place 21 months before finally reversing, after which 50% was erased in about 3 months. And as we looked at in the latter portion of that presentation, this reversal was happening even as the Fed continued to hike rates aggressively. But markets were looking on the horizon and were starting to factor in the possibility that the source behind that trend, the Fed's aggressive rate hikes as the Bank of Japan stood pat, might change. And this denominated a fresh bearish trend, even as the fundamental backdrop remained decisively tilted to the long side of the pair. In the move that took 21 months to build, with the fundamental backdrop supporting and driving the trend, it only took 3 short months to wipe away 50%, even though there was only the prospect of possible change. And this is why traders should look to use both fundamental and technical analysis. because both offer differing yet important pieces of information that can be integrated into the approach, an effort of trying to get the probabilities on the trader's side as much as possible. While fundamental analysis focuses on inputs to an economy, an effort of forecasting what might happen with price, technical analysis takes a completely different approach by investigating the chart and where prices have moved in the past, an effort of forecasting what might happen in the future. But it's important to note this up front, as traders that get involved with technical analysis might have a tendency to rely too heavily on past prices, which can create a number of problematic scenarios. It's important to keep in mind that history does not repeat. For a technical trader, we can probably go off of the saying that if history doesn't repeat, it might rhyme. And that's something that could lead into trade ideas that a trader can then build strategy around. Technical analysis can offer traders two major points of emphasis for forward-looking strategy. And the first are trends. The trend is your friend, as the old saying goes, and this is speaking directly to the fact that there's been a prevailing trend in the marketplace, and this might possibly continue. Trends are usually taking place for a reason, like we saw with dollar-yen. That reason was higher rates out of the United States Federal Reserve, which were resultant from higher levels of inflation that the bank was looking to ward off. A trend could potentially help a trader to generate a bias in the direction of that trend, so that if what's been driving price continues to do so, the trader can potentially find a workable bias in that market that they can then focus on. The other aspect of technical analysis that's of importance is support and resistance. Support and resistance is simply a price or a zone that's had or may have a tendency to bring buyers or sellers into a market. This doesn't mean that it will always set a floor or a ceiling for price, but it does show the trader something that potentially might happen. And when setting up a trading strategy, potentially may be enough for that trader to generate an idea. There are numerous uses for support and resistance in technical analysis, with risk management being a big one. If a trader is looking to buy a market and gets long, and then support gets broken, do they really want to hang around in that position and hope that things turn around? It's really up to them, but generally speaking, hope is a terrible trading strategy. And instead, traders can use support and resistance to invalidate trends, saying, the bullish uptrend that I want to buy is no longer in as bullish of a state because support has been broken. And this can then become an area to investigate for stop placement, so that when the idea doesn't work out, loss mitigation can become the priority. But beyond that, support and resistance can help with strategy itself in setting up breakouts or reversals, or even if just identifying a range-bound market. This brings on a major topic of importance, trading strategy. We have an entire module dedicated to this topic, but in reality, we're going to need to introduce it here, because teaching technical analysis without any aim of how to use it makes very little sense. The entire point of using technical indicators or technical items is an effort of getting trading ideas. But if we don't have somewhat of a systematic approach with that as a technical trader, it can be difficult to improve or optimize, as each trade or iteration would be somewhat unique from the last. But if the trader has a consistent strategy and it's not performing well, we know that we need to tweak that strategy. The trader can then make modifications and can then move on to testing out the enhanced or optimized strategy. In the latter portion of today's discussion, we're going to open up this topic. We're going to create a simple strategy with the tools that we're discussing today, showing how various indicators can be incorporated to complement each other. And then we're going to move into a series of strategies with differing aims based on how the trader wants to engage with the market. We're going to show how this can be automated or set up in an algorithmic approach using the Capitalise.ai platform, which can enable automated, systematic trading with simple language and no coding required. But all big things have to start somewhere. Let's get started with indicators. Indicators can be a divisive topic amongst market participants, but to get it out up front, no indicator quote unquote works all the time, and this could then lead to derision. Indicators are simply tools, like a hammer or a wrench. An indicator is a tool designed to help the trader see what's happening on the chart, and there's almost an endless number of indicators that can be used. But most are all based on the same thing, the past. And just like price action or any other field of technical analysis, the past does not predict the future. Indicators can help new traders to simplify the chart. The question will often come up, which is the best indicator? And I don't believe that there is one, as best is a very subjective type of matter, and these are just tools that are based on past prices, which do not predict the future. Indicators can help with strategy though, and we're going to look at a number of possible setups for the logic of a technical strategy later in this presentation. We're going to look at simple strategies to use as an example, but I want to point out up front that these are just samples of entry logic, which is just one component of what makes a strategy work. Arguably, if not more important, is the risk management protocol of the strategy, which we will not be addressing at length today. But we do have an entire module in part 5 of the course dedicated just to risk management. Technical analysis and technical analysis with indicators will often be used as the input for automated strategies. Automation is something that's had an increasingly important role in markets, and this is something where technical indicators can have a large bearing on the overall conversation around strategy architecture. We're going to look at some examples of this later on in the session, and this could also be a fantastic way for traders to get feedback or information on the basis of back tests or perhaps forward tests using a demo account. Before we get into the topic of indicators, I want to reiterate a couple of important points that should not be lost in the discussion. Technical analysis is an examination of the past, an effort of finding what may happen in the future. And emphasis is on may. I keep harping on the fact that the past does not predict the future because many new traders that begin to learn technical analysis will see that it doesn't always lead into good ideas, and then they'll dismiss it out of hand. I do believe that technical analysis can help traders to find value, but I do not believe that it's predictive. And the reason is the very same that the past does not predict the future in any other venue of life. Because new stuff happens all of the time. And that's what makes it fun, interesting, and exciting, and sometimes frustrating. Trends are important because this is a bias that's shown in the market. There's probably a reason of some sort for that bias, which may be explained by the fundamental environment, such as we discussed in our previous module. If there's an observed trend, it might continue, and that's something that a trend trader can use when developing their strategy and approach. Support and resistance can be helpful for risk management because, again, the past does not predict the future, and as long as you run the risk of one short-term trade becoming a long-term problem, trading could remain as a frustrating field to study. But support and resistance can be helpful for risk management, as well as overall trading strategies we're going to explore in this module and in future modules. As I mentioned a moment ago, indicators are like tools. They are unintelligent in that they will take whatever data is fed into the equation that makes the indicator, after which they will deliver a value of some sort. That value can then be charted along with price so that similarities or deviations can become more noticeable. But in the same way that a hammer can't tell you what eurodollar will do tomorrow, neither can a moving average or RSI. But like a hammer, just because it can't predict the future, it doesn't mean that it's without use. So let's look at some ways of using indicators. There are a plethora of indicators available to traders. The question will often come up, which indicator is best? And again, I don't think that there's an accurate answer to that question. Best is going to be matter dependent based on a number of other variables, namely the trader's strategy and approach. As a case in point, the moving average is usually the first indicator that many traders learn. It's simple, and it makes sense. It's simply the closing value of the past X periods added together and then divided by X to get an average value over the past X number of periods, and this can then be plotted on the chart. If prices are trending higher, then the moving average will trend higher as well, as the new values being fed into the equation increase with higher prices. And eventually, when prices cross below the moving average, and then the average begins to register lower values, the moving average will move lower as well. This is an uptrend turning into a downtrend. But the problem with the moving average is pretty obvious. It's the lag. So traders will often move away from the moving average and onto other indicators simply because of the lag that's ever present. But if we think about it, wouldn't other indicators based off of past prices have the same problem? Because after all, if an indicator is taking past price values and deriving some type of quotient from that, we can say that most indicators are just some form of a fancy moving average. This can still help traders to get ideas, however, and for traders that do put together a technical strategy of complementary indicators that do slightly different things, they could create a technical trading strategy similar to the logic that's used for many automated strategies. One important note on the topic of indicators. When learning indicators, there will often be a question as to whether an indicator can be so widely followed that it might open the door for some type of self-fulfilling prophecy, so that when that event happens, so many traders see it that they all react in the same manner, thereby producing the desired effect solely because of the action of an indicator. I want to caution you on that, because the idea that a single technical indicator will take on such a role in a market that it will change investors and traders' minds in and of itself seems a bit of a stretch. And again, this is reality, so new stuff happens all of the time. This does lead to considerable focus on popular technical indicators, though, like the 200-day moving average, which will often get mentioned or noted on news programs when it comes into play for a major market like the S&P 500. Also popular is the 100-day, the 50-day, and 20-day moving averages. And between the 50 and 200-day moving average, there's often focused on the golden cross, which is what happens when the 50-day moving average goes up and over the 200-day moving average, or the death cross, when the 50-day moving average goes down and below the 200-day moving average. But the 200-day moving average is a very popular indicator across markets. Let's explore that a bit further. This is an example of the 200-day moving average applied to the pound-dollar currency pair from the beginning of 2020. This is an example where a moving average like the 200-day can be helpful for trend identification and can even help with support and resistance. We'll notice here that not every touch leads to an inflection and not every crossover leads to a new trend. But there are multiple instances in this example where the trend continued for some time after a crossover took place. And there are multiple iterations of resistance or support coming in right at the 200-day moving average. There could be multiple things going on here with each of those instances, but with so much attention paid to the 200-day moving average as one of the more popular technical indicators, it could be difficult to assume that the 200-day moving average had no impact at all in the matter. Some tests of the 200-day would have led to inflections or fresh trends, while others failed. But again, the important takeaway is that this isn't something that always works, but something that may work. The trend is your friend, as the old saying goes, and a moving average can help with trend identification that could allow for the technical trader to generate a bias. One option for incorporating a moving average, such as the 200-day, is to use it as a trend filter. This would be like an if-then statement at the front of your strategy that says, if price is above the moving average, look for long positions and long positions only. This could be done from a shorter time frame, or it could be used on the daily time frame with some mechanism for deciding when to enter in the direction of that trend and in the direction of that trend only. So again, if price is below the moving average, traders are looking for short positions and short positions only. If above the moving average, traders are looking for long positions and long positions only, as they're filtering the trend as defined by the relationship with the 200-day moving average. Of course, there will be scenarios where prices remain choppy when encountering a moving average. And this is the period when the trend would not have significant continuation potential after a crossover. You, of course, will not know that until it's too late. But that's not the point. The point is to try to get some form of bias from what's shown in the market, and using a moving average as a trend filter is one way to move towards that end. This is the same chart as before, but this time we sped up the moving average. We're now using a 100-day moving average versus the 200-day that we looked at a moment ago. Notice that the trend transitions happen much more quickly now. And the reason for this is the lessened lag of 100 periods versus 200. But the trade-off is that the transitions are sloppier, specifically looking at those three boxes near the middle of the chart. And when we saw this on the 200-day moving average, the first inflection in the blue box inside of the green box, that was a test at the 200-day moving average. The greater noise produced by the smaller sample size made that inflection less clear than the longer, slower, more laggy 200-day moving average did. But also notice there were other periods where the 100-day moving average came in as support and then as resistance. And like we saw a moment ago, this could be used as a trend filter to help traders decide which direction they want to trade the move. In this example, we sped up the trend filter even more, now using a 50-day moving average. And again, notice that this time it's even more responsive and the transition's even faster than before. This may not be a great thing for a trend filter as there are so many changes here, especially near the top of the move as the trend was turning. As a trend filter, that can be dangerous just because there are so many transitions. But for those that are focusing on shorter term strategies, that might not necessarily be a bad thing. It really all depends on what the trader wants in their strategy. And one of the problems produced by a longer trend filter, like the 200-day, are those periods where price is above the 200-day moving average, but already moving lower. Or those periods when price is below the 200-day moving average, but already moving higher. This is due to lag, which can be partially offset with a faster moving average. But that then introduces more transitions and a higher probability of noise given the greater frequency of crossover events. An important thing to remember when building a strategy, particularly a technical strategy based on indicators, is that flat is a position too. You don't always have to be long or short, and this could be a massive advantage as this can allow traders to pick their spots for when their strategies might be most appropriate. In this example, I've added all three of the previously investigated moving averages, and now the trader can choose to only look at long positions when price is above the 50, which is above the 100, which is above the 200. Given the lag from the various moving averages, this would be like trying to isolate strong trends that are well entrenched. The key takeaway here is to notice how much less opportunity is available simply because we're filtering out so much of what had happened, only allowing for short positions when price is below the 50, which is below the 100, which is below the 200. This can allow the trader to really filter out for established trends. This would also have the associated aim of trying to eliminate following a trend after it's already begun to reverse, as the lag produced by the 200-day moving average would be lessened, as the trader also has the 50 and 100-day moving average to assist with trend identification and trend invalidation. But there's still the matter of deciding how to enter positions, and this could be done in a number of ways, including with another indicator. Taking the indicator conversation a step further to look at strategy creation, the moving averages crossing over can be seen as an event unto itself. The golden cross is when the 50-day moving average moves up and over the 200-day moving average. If we think through this, this is like highlighting increasing bullish momentum. The 50-day moving average only takes in value from the last 50 periods, while the 200-day takes on values from the last 200. So as price increases on this bar or the next, the 50-day moving average will be impacted more than the 200-day moving average, simply because there is less lag in the 50 versus the 200. So the golden cross is indication of increasing bullish momentum. The death cross is the opposite. This is when the 50-day moving average crosses down and below the 200. This is a sign of increasing bearish momentum and may be a sign of a bearish trend getting started, as the lower prices would have a greater pull on the shorter term moving average due to less inherent lag. This is a daily chart of Euro-Yen going back to September of 2017, and there are two different moving averages applied here, with the 50-day and 200-day. When the 50-day goes up and over the 200, that's called the golden cross, and is often considered as bullish. I've noted three different golden crosses here with blue circles, while the red circles are the opposite, the death cross, when the 50-day moving average crosses down and below the 200. The blue circle in the middle of this chart and the final blue circle both look as though they would have panned out well for bulls, but there were others that would have fared far worse, such as the first blue circle that we see, or the green circle towards the right half, which was a crossover that quickly reversed course. As to whether or not the golden cross works out for the trader, that's dependent on the trend. If the trend does continue, then the golden cross could end up looking as very attractive. But this doesn't always happen. It's merely an idea for what may happen. This is the same chart that we looked at a moment ago, and in effort of not cherry picking picture perfect examples, we're going to go with this one. The death cross is the opposite of the golden cross, and this is when the 50-day moving average slips down and below the 200. This is often considered as bearish. The first crossover on the left side of the screen showed up before a 1,000 pip plus decline in euro yen. But the golden cross that followed shortly after would have been a rough signal for bulls, as prices continued to trend lower after that, even firing off another death cross, as noted by the second red circle from left. And then there's another red circle located to the right of the middle of that chart, and that would have been a rough trade for bears, as prices violently gyrated back and forth until bulls finally took control months later. There's a fourth death cross on the right side of the screen, and let's assume that that one also will fail. Collectively, only one of these four instances looks as though it would have led to any significant continuation, and a 25% win rate might not sound all that exciting. But if the trader was looking at 500 pip limits and was using 100 pip stops to trade short positions each time a death cross appeared, this trader could still look for a net profit, even if only winning 1 out of 4 times. The one win could account for 500 pips gained, while the 3 losers could have accounted for 100 pips lost each time before taking into account spreads, slippage, or any other additional costs. This could equate to a net profit of 200 pips, even if only winning 1 out of 4 times. We will cover this concept in greater depth in our module on risk management, but for now, the point is that technical indicators aren't meant to be perfect, because the past does not predict the future. But trends do exist, and this is something that the trader can attempt to incorporate into their approach. Again, the point here is not to sell you on the golden cross or the death cross. It's to highlight something that may help you to align probabilities. And while not every golden or death cross leads to a strong trend that can be picked on for months, some do. And for the trader, that can be valuable information. Taking technical strategy to the next step, we can begin to look at the prospect of triggering trades and executing positions. To illustrate, we can combine a couple of concepts that we've already looked at by using a trend filter to help with directional biases, and the golden cross can help towards that end. When prices are below both the 50 and the 200, there's a bearish trend. Maybe that continues. The trader can then incorporate another tool in effort of finding opportunities to sell high and cover lower. Or, for the golden cross, when prices are trending higher and prices leading the 50-day, which is leading the 200-day, well, then there's a bullish uptrend, and that bias might continue. So the trader can then take a bullish bias into the matter on that prospect of continuation. And then additional tools can be created or incorporated to try to set up bullish trades in the direction of the general trend. This can be done with any number of indicators, such as stochastics, or MACD, or RSI. Even the Commodity Channel Index, or CCI, which is another oscillator, can be an option. Traders can even incorporate something a little different, like pivot points, which are designed to highlight support and resistance potential based on prior periods' price activity. If the trader has a bullish bias, they can then look for support to come into play, and pivot points can offer a number of support levels that can be used in strategy creation. If indicators are tools, then the moving average is like the tape measure. It can be applicable for many purposes, even if it's not a cure-all. The tool itself doesn't accomplish much, but it does offer a lot of information that could then be used to make good decisions. I'm going to pick on one of the more popular oscillators to investigate some points of strategy and technical analysis, but by no means is this an end-all, be-all, or holy grail type of indicator, or even strategy. MACD stands for Moving Average Convergence Divergence, and quite simply, it measures the relationship between two moving averages and plots that relationship on the chart. In the boxes for fast and slow links, we will see the values of the moving averages being measured. The default settings for MACD on most platforms are 12 and 26. So the MACD value would be a measurement of the distance between the 12 and 26 period moving averages. As those moving averages converge or cross over, That's measured as the convergence-divergence portion of the indicator. This argument could be extended, however, as there's another moving average that's added as a moving average of the MACD line. This is called the signal line, which is often plotted at 9 periods by default. This is a way of further tracking momentum. We'll get more in depth with the indicator on the next screen. This is what the plotting of MACD looks like. Often found at the bottom of the chart, the line in blue is the MACD line, measuring convergence or divergence of the 12 and 26 period moving averages. The zero line for the indicator can be seen by the black bar going across the middle of the chart. When the 12 period moving average crosses the 26 period moving average, the MACD line will cross the zero line. If the 12 period moving average goes over the 26 period moving average, MACD will cross up and over the zero line. If the 12 period moving average goes below the 26 period moving average, the MACD line will go down and below the zero line. When a trend picks up and gets more bullish, the 12 period moving average will move up higher, faster than the 26 period moving average due to the lessened lag, just as we saw with the golden cross. And as that shows continued divergence between the two moving averages, the MACD line, here in blue, will also move higher. But when price stops trending higher, and when the 12 period moving average begins to register lower prices more quickly than the 26 period moving average, this is when the MACD line, again in blue, will start to tilt lower. And when it breaks below its own 9 period moving average, or the signal line, here in orange, that's seen as a bearish signal, indicating increasing bearish momentum. We're going to get more detailed with our example here, and in an effort of not cherry picking, I want to pick on a trend transition as price is crossing the 200-day moving average. For a trend following strategy like this, that can be a difficult time, as the bias shown from the trend filter isn't great. But a filter can help by removing some of the signals that are present. And in this example, I'm highlighting all relevant signals per the strategy that took place on the daily chart of GBP USD from April of 2021 into March of 2022. Now, the past does not predict the future, and this strategy is not perfect, but it does incorporate two different points of reference with the moving average and MACD in effort of building a technical strategy with complementary inputs. The strategy logic is fairly simple. If price is above the 200-day moving average and MACD shows a bullish signal, a long position is investigated. And when the indicator flashes a bearish signal, that's an exit for longs. Because price is above the 200-day moving average, the bearish signal would not come with a signal to open a short position. When price is below the 200-day moving average, only bearish signals are taken. Bullish indications from MACD are then an exit signal for short positions. If we think about this, what this strategy is really trying to do is capture momentum-based entries in the direction of the longer-term trend. When the 12-period moving average crosses up and over the 26-period moving average, thereby leading to an increasing MACD value, that can allow for bullish trigger when the MACD line crosses up and over the signal line. And because the trader is filtering those indications by only taking the signals that agree with the directional posture of price and the moving average, the trader is trying to focus on only positions moving in the direction of the prevailing trend. On this chart, I've added black boxes around all of the periods that this hypothetical strategy would have been active. And while there are some strong trends, there are also some signals that did not work out, especially around the 200-day moving average trend transition itself. I've tried to avoid cherry picking, and on the last example, we looked at an environment that was ill-suited for trend following strategies, as the market was in the process of a transition, as denoted by the crossover of the 200-day moving average. This chart is looking at what happened after that, as we're looking at GBP USD on the daily chart from February of 2022 until March of 2023. In this case, the logic is the same as looked at on our last example, but price remained below the 200-day moving average for much of this time, which allowed the trader to retain a bearish bias for much of this chart. When price was below the 200-day moving average, there were a number of bearish signals as produced by the MACD indicator. Because the trend filter denoted a bearish bias, only the bearish MACD signals would be followed. The bullish MACD signals, however, would be exits for the short position, as the indicator would be signaling increasing bullish momentum. And if a trader is short, that might not be a good thing. After price crossed above the moving average in late 2022, the trader would then be looking for bullish signals and bullish signals only per the MACD indicator. Bearish signals per MACD would similarly be used as possible exit signals, as increasing bearish momentum while the trader was long could highlight a possible reversal. What we've just done with this very simple format is we've created a strategy or a system, and the trader can then use this to look for trade setups in the marketplace. While arranging our indicators and our decisions in this format will not ensure against losses, it does aim to position the trader in an opportunistic position by aligning the strategy being used to generate ideas with an environment that may be best fit for that strategy. Now that the core logic for the strategy is created, the trader can then generate more data to get a better idea for how this strategy might perform. This has been a quick introduction to systematic trading, but now we're going to explore this topic in greater depth. The base of a technical trading strategy or system is going to incorporate a set of indicators that can help to provide trade ideas. But there are different ways that a trader can incorporate this information, and this brings up a larger topic regarding how the trader wants to engage with the market. In a general sense, there are two ways that a trader can go about coming up with trading decisions. Discretionary, in which they use their own analysis to come up with ideas on a regular basis. This discretionary approach could incorporate a system, but more for informational purposes, as the trader could then choose to ignore signals generated by the system. This would make the strategy more subjective. There could be less consistency with such an approach, but significantly more freedom, as this trader isn't confined to any boundaries. As you can imagine, that type of approach can work well for some, especially those that like adventure, because, after all, this is an adventurous way of navigating a market that's changing day by day. A systematic approach can be used in an automated or manual format, since the system itself would have an element of objectivity that could be coded into a trading platform. The strategy that we just created would be considered a manual systematic strategy, but it can easily be automated, which we'll look at in a moment. But this is really just the tip of the iceberg. So let's look at some other strategies that we could work with in a similar format. Over the next series of screens, we're going to begin looking at trading strategy to address market conditions. And this is a bit of foreshadowing for our fourth module that's dedicated entirely to this topic of trading strategy and market conditions. At this point, there's a lot more to discover, mainly just because there are so many options for traders. Years can be dedicated to this field of study, with still more to learn. But I wanted to share some very general pointers to specific types of technical strategies that can help to create logic using technical indicators. A systematic approach leans heavily on the strategy itself, as this is the center of the system. There are endless possibilities for the strategy, and I urge you to explore some of the options that we're going to talk about today. Over the next few screens, we're going to look at a few different types of strategy, focusing on entry logic, but that's just a portion of the overall strategy's performance. These are not recommendations, but examples, which try to fit an indicator or series of indicators together to look at ways of addressing different market conditions with an appropriate strategy. The Capitalise platform is an available option to get data behind these questions, as it can allow for backtests, which will see how the strategy would have performed in that specific look-back period. Backtests can offer a considerable amount of information and data to a trader, but it should not be relied upon on its own. Because again, the past does not predict the future, and maybe the period that you've tested for the strategy was particularly suited to that system's characteristics. Forward tests could offer more data, however, as this will show how the strategy performed in a live demo environment. The downside of this is that it will take time, but that added information can be key for those who do want to go down the path of automation, as this would be the next logical step for testing a system after generating and running backtests. The aim here is to learn, because like most other ventures in life, experience brings knowledge, and that can better equip you for the challenge ahead. And automation can help in providing a lot of data in a relatively short period of time. On this screen, we are looking at the automation of the strategy that we've built today, focusing on the long side of the market. The first part of the statement addresses the trend filter. And again, this is like an if-then statement at the front of your strategy. If GBP USD is above the 200-day moving average, then the strategy can move forward to the next step. If it's not, then the strategy will fail to proceed. This would mean that the strategy is just waiting for the pound-dollar price to move over the 200-day moving average before it can be active again, looking to move on to the next step of the logic. The next part of the statement begins to address the MACD indicator. This is being used as a trigger for the strategy to open new positions, and there's even an option where you can modify the input values for the indicator. As shared earlier, the common default inputs for MACD are 12, 26, and 9. And that's what we've used here, also noting that this is based on the closing prices of the daily chart. The next part of the statement addresses the trigger itself, saying that when the MACD line crosses above the signal line, that's what produces a signal. And when that happens, the program is being instructed to open a 10K GBP USD position. Again, this only addresses the entry logic of the strategy, and the exit has a few other options that traders can work with. In our example earlier, we used the MACD indicator itself to close positions, but there may be another way that can help with regards to risk management. We are now looking at the exit logic for the strategy, which is the next step when using the Capitalise platform. From here, traders could select how they want the position to exit. In today's discussion, we used indicator logic to close the position. Since we were only looking at MACD triggers that were in agreement with the trend as defined by the 200-day moving average, we were also able to use the counter signal from the indicator to close the position. And this is certainly one way of going about it. This would be using indicator logic to exit positions. But another manner of managing risk, and this is something that we will discuss in much greater depth in our 5th module on risk management, is on a percentage basis. Do you remember that first chart that we looked at in our fundamentals module? The one where we outlined the catastrophic loss and how much more of a gain a trader would need to realize just to get back to their original point of break even. Well, managing risk based on a percentage of account equity is looking to isolate that variable by risking only 1 or 2% of the trader's account on any one idea. What we're looking at on this screen is exactly that, where the trader is telling the program to exit the position if the position's loss entails 1% of the trader's account. But what if things work out well? Well, in that case, we've attached a profit target here of 2%. This would be a 1 to 2 risk to reward ratio. And this would be seeking to take advantage of what we had looked at earlier with the death cross, of trying to maximize the benefit when the trend does continue after the signal, while also trying to mitigate the damage for when it doesn't. What's the best risk-reward ratio? Well, that's dependent on a host of other factors. But this is something that will be addressed in greater depth in our section on risk management. With the power of automation, traders can learn quite a bit about how various technical indicators can work with each other. I wanted to cover some of the more popular tools here, along with their common usage, in order to provide some ideas for how you might be able to begin to build your own trading strategy. In the strategy that we built today, we used a simple moving average to define the trend, and then the MACD indicator to enter trades in the direction of that trend and in the direction of that trend only. But MACD is from a family of indicators known as oscillators, and there are other similar oscillators that may be more or less beneficial based on how you want the strategy to perform. Stochastics, RSI, and the Commodity Channel Index are all popular oscillators that try to do a similar thing that MACD did in our earlier example. RSI is generally going to offer fewer signals than MACD or CCI, while CCI will usually be a bit more active, especially in high volatility environments. Stochastics has a similar format as MACD, where there are 2 lines in the oscillator, known as %K and %D, which offers a crossover in the indicator to denote a possible signal. You can test each of these indicators with a trend filter to see which might work best for the strategy that you want to build. Moving averages are incredibly utilitarian indicators. As we said earlier, could be looked at like the tape measure. As we saw with the death cross or the golden cross, an entire strategy can be built using only moving averages. There are a few creative ways that this can take place, but think about it for a minute. If you want to trade a trend, and you only want to be in the move when the trend is going in that direction, using a setup of 2 moving averages can help towards that end. A fast moving average and a slow moving average can be used together, and the trader can investigate the crossover, which is traditionally going to be laggy. But they can also use the fast moving average as an entry indicator, provided that the fast moving average is in proper position with the slow moving average. So rather than looking for the death cross or the golden cross, the trader would instead be looking for instances when price crossed below the 50-day moving average after a death cross or above the 50-day moving average after a golden cross. Again, these are tools, so use them as you see fit to accomplish your mission in the market. Highs and lows are also popular, and this is a common point of reference for breakout or reversal traders. The very act of price pressing into a fresh high or a fresh low can be a notable event in and of itself. Maybe it continues, maybe it doesn't, and there may not be a way of gauging which will happen with any degree of frequency. But again, risk management matters, so you might not even need a 50% win rate to build a profitable model, as the size of gains and the size of losses also matter. Price channels are a manifestation of the highs and lows that we just touched on, but this can be delivered via an indicator known as Donchian channels. We're going to discuss that in far greater depth in our 4th module on trading strategy, and we'll explore a bit more in an example that we'll look at in a few minutes. There are numerous ways of identifying support and resistance in a market. Recent highs and lows are certainly one way to do so, but there are other mechanisms available as well. And for new traders that are still learning or building out their support and resistance identification, pivot points can be very helpful. Pivot points were actually some of the first support and resistance to become popularized. Floor traders who didn't yet have access to computers or calculators needed a fast way to identify a relative high or low for prices. So they used some simple back-of-the-envelope math, taking the prior day's high and low and close, dividing that by 3 to arrive at a value. That value is then the pivot for today. But from that value, the floor trader could then take the pivot value and multiply it by 2, then subtract yesterday's high to arrive at a theoretical support level. This would be an S1 pivot. They could then take 2 times the pivot and then subtract yesterday's low to arrive at an R1 value. This would be the first level of resistance. From there, more values can be created to provide multiple support and resistance levels. You don't need to know the math, but if bullish and looking to buy, a support test may be enough to open the door to entry opportunities. And pivot points can be a simple, objective way to identify support and resistance in an automated trading strategy. We're going to look at Bollinger Bands in a minute, so I'll keep the discussion on that short for now. But this is another way of trying to read relative expensive or cheap, given the context of the market at the time. At this point, we've investigated a trend following strategy, but let's change course. Let's see the market from the other side, taking the vantage point of a trader looking for reversals. Up to this point, the bulk of our discussion has centered around trend following strategies. This can be a popular way of approaching markets, but it's also not something that will work for everyone. And as said numerous times already, the past does not predict the future, so just because the bullish trend is driving today, it doesn't mean that it has to continue tomorrow. And there are other ways that a trader can look to engage with the market. Another market condition that traders can look to address with strategy is the reversal. Are you the type of person that questions much of what you hear? If so, don't worry. That's not uncommon amongst traders. This is called contrarianism, and this can be voiced through technical strategy, as reversal traders are often looking to sell tests of highs or buy tests of lows with the expectation the price may revert back towards the mean. But if a trader is going to say that the market is incorrect and the prices are due to revert back towards prior levels, they need some reason to base that argument off of. And this is where support and resistance come into play. And again, there are numerous ways of identifying the support and resistance, and we're going to investigate some indicators that may be able to help towards that end. Reversal traders need to keep in mind that they are generally going in the opposing direction of the general trend, which can be thought of as trying to swim upstream. If the breakout or new trend lasts for a long time, the reversal trader could be looking at a massive loss if the position is left unchecked. So these traders are also usually going to need strong risk management protocol to keep their strategies and accounts in working order. Bollinger Bands are a popular indicator that are essentially a function of a moving average. The Bollinger Bands will be plotted as a standard deviation of the user's choosing, commonly with a value of 2. This would be 2 standard deviations from the mean plotted above and below the mean or moving average. Bollinger Bands are designed to help traders see relative high or low values when price tests beyond those standard deviation bands. So when price moves up to the upper Bollinger Bands, the thought is that there's a test of extremes, and this may be something of note. Traders at that point can look to either buy the high in anticipation of the breakout, or they can look to sell the high in anticipation of the pullback. Or similarly, when prices move down to test the lower Bollinger Band, there's a test of extreme lows. The breakout trader can look at a test of those extremes as a continuation opportunity. So if prices are testing the upper Bollinger Band, the breakout trader could look for long positions in anticipation of the fresh high, leading to even fresher highs. But the range or reversal trader is probably going to look at that in the other direction, as an opportunity to sell high when price touches that upper extreme. The logic of this strategy would be to trigger bearish when price tests the upper Bollinger Band, in this case using 2 standard deviations of the 20-period moving average. A strategy like this could perform well during periods of choppy market activity, but during strong trends, traders could end up in a difficult spot as the strategy logic would be continuously selling fresh highs. Let's look at how a simple program of this nature could be built. This is the same strategy looked at on the previous screen, but here it's been input into the Capitalise platform. In this case, the trader would be looking to sell when price crosses above the upper Bollinger Band. Similarly, the trader could set the strategy to sell after it crosses below the upper Bollinger Band, depending on how the trader wanted the strategy to perform. Which is best? That's a good question. And the platform's backtesting and forward testing capabilities can help to put some data behind answers to that question. The strategy as shown would be looking to open sell positions if or when price hit a relative extreme high. But perhaps triggering short positions is more advantageous when price crosses back below the upper Bollinger Band, driven by the argument that prices are already reverting back towards the mean. In that case, the only change that would need to be made here is where the line of text says above, well, that could be changed to below. At that point, the trader can then make an apples-to-apples comparison of the two strategies with either back tests or forward tests on a demo account to get more data with which they can then make a decision. Breakout trading is taking the opposing view from the reversal trader, as breakout traders are usually looking for prints of fresh highs or lows to lead to a continuation move. And as we've all seen multiple times already, not every fresh high or fresh low leads to a strong move. So these traders, similar to the reversal trader, need to remain extra cautious around risk management, as a short-term trade can quickly become a long-term problem if risk management is left unchecked. Many new trends start from an initial breakout, so the door could open for an extended move when they do happen. But traders need to remain extra cautious for when they don't, as 1 or 2 bad trades, also known as false breakouts, can quickly zap a trader's account of equity. Like the reversal market condition, support and resistance are large components behind breakout strategies, and there are numerous ways to find out which support and resistance levels a trader can use for such an approach. We're going to look at an interesting indicator on the next slide that incorporates price action in effort of finding support and resistance levels that can help towards this end. Again, breakout trading is looking for continuation of fresh highs or lows. And on this chart is one of the more popular indicators for tracking highs and lows, known as price channels, aka Donchian channels. This indicator is named for famed speculator Richard Donchian, who is chronicled in the book The Turtle Traders, which talks about seasoned market vets teaching new traders how to navigate markets. Donchian channels or price channels will simply note the highest high and the lowest low for the last X periods, where you get to choose X. A common value is 20, as we have displayed here on this chart of GBP USD. The breakout trader is often taking a stance directly opposed to the reversal trader. While reversal traders will look to sell fresh highs or buy fresh lows, the breakout trader is usually looking to buy highs in anticipation of even higher highs, or they look to sell lows in anticipation of even lower lows. And sometimes that could lead into a strong trending environment. Others, however, the breakout trader might wish they were a reversal trader instead. Whether the breakout continues or not will likely be determined not by price channels or by Bollinger Bands or any other technical indicator, but more likely related to the context of that market, which includes the fundamental criteria that's pushing prices at that point in time. And keeping on that note of opposites, the previous strategy that we looked at, built on reversals, could be more opportunistic in ranging grinding markets. The breakout strategy, however, is usually looking for fast-moving and trending markets, since it is, in essence, buying highs and selling lows. Such as we saw with the example around the death cross, the trader using a breakout strategy may not even be looking for a 50% win rate. Instead, looking for those relatively rare circumstances when the breakout does run, which could allow for larger risk-reward ratios. But a key for that to work would be loss mitigation in those situations when the trader was on the wrong side of the market. Let's see how we could get some feedback around such a strategy. On this screen, we're looking at the entry logic for the strategy that we had just discussed. In this case, the strategy is set to buy 10K pound dollar when the pound dollar price crosses above the 20-day high. Again, that's looking to take advantage of that new fresh extreme by buying in anticipation that it might continue to go higher. But again, the point here is not the entry logic. It's to see how the exit logic could make the strategy better or worse, and whether or not it's even something we'd want to work with. To illustrate the flexibility of support and resistance, the same logic that we looked at a moment ago can be incorporated by reversal traders. Reversal traders or traders looking to build reversal strategies can work with the very same logic, but they can do so by looking to sell fresh highs, as opposed to buying at that point. Whether or not the reversal or breakout takes hold will likely be dependent on fundamental factors at the time, and this is one of those areas where a trader can begin to mold the strategy more towards their own personality. Are you someone that considers yourself to be somewhat skeptical in a general type of sense, or perhaps contrarian? Those types of people might find reversals as more comfortable, as that type of strategy might fit their personality and worldview a bit better than a breakout trader, who's essentially looking to harness excitement and newness into fresh new highs or fresh new lows. Which is better? Depends on who you ask. Many traders will compare two strategies of this nature and will then try to make an objective statement of which may be optimal, whether it's the reversal or the breakout. But I want to caution you on that, because it dials back to the same argument that we encountered a little earlier. The past does not predict the future, and if we're doing a back test to get data, we have to consider that the unique backdrop at the time of that backtest may have been better fit for one strategy or the other. That doesn't mean that it will continue. This speaks to sample sizing, as making an objective determination of that nature will require significant time and testing. And this is why customization of strategy to one's personality is such an important variable, because you're going to have to hold these trades, and if you're using something that doesn't feel right, if you're a skeptical person that's generally contrarian, yet you're buying each fresh breakout, that might not be a comfortable arrangement. And 3, 4, or 5 months down the road, if you're doing something that still doesn't feel right, you might not want to do it for much longer, especially if the results aren't there. We're going to get much more in depth with trading strategy in our 4th installment, and this could be a good time to start thinking of how you want to build your strategy and approach in your trading plan. And lastly, in regards to trading strategy, there is no one right way to do it. There are some wrong ways, however, like trading a strategy before testing it or blindly taking entries or trades as driven by hope. To the trader without a plan or without a strategy, they are constantly vulnerable. A trend-following strategy can be a simple way to move towards the aim of having a more controlled approach. And with what we've learned today, there are numerous ways that you can evolve that from here. We had looked at a 200-day moving average as a trend filter and then used MACD for entry opportunities in the direction of that trend and then in the direction of that trend only. Well, you can modify this to your liking. And on this screen, you could see a version of a very similar trend following strategy. But in this example, I've sped up the trend filter using 21 days versus 200. And I'm using an exponential moving average now versus a simple moving average, in effort of making the filter more responsive to near-term moves. And instead of using MACD to trigger entries in the direction of the trend, this strategy is using the relative strength index to do so. Which is better? I don't know. Again, this will be matter dependent, and with the tools covered in today's discussion, you have numerous resources to learn more about how you can build your own bespoke approach to engaging with the market. As I've said numerous times throughout this presentation, technical analysis is simply examining the past in effort of projecting what may happen in the future. Technical strategy is not about prediction, and anyone using technical tools as a decision point for their trading plan has to know this up front. But a trader's analysis can help to align probabilities, even if that retains a degree of uncertainty as well. With technical analysis, we can observe trends and identify support and resistance levels, and that context can be integrated into a strategy-like approach. Just like we looked at in fundamentals, data announcements can be especially challenging because this is when new information is getting priced in, and thus, this can be an inopportune time to use observations from the past to get an idea for what might happen next, because something new is getting priced in right then and there. Technical analysis is rooted in the past, but that does not mean it can't help. It only means the utility of that analysis is more clear and transparent in the fact that it's obvious that the past does not predict the future. What is necessary is some element of balance between a trader's strategy that's focused towards the trader's approach, outlook, or personality, and a good risk management plan, which is part of a trading plan, which we will discuss at length in our final installment of this course. In closing, strategy should be fit to the market condition and environment. Trading a trend-following strategy during a ranging market can lead to unsavory results. We're going to talk about market conditions and trading strategy in our fourth installment on that very specific topic, while looking for ways to best orient our strategy towards markets that may be most fitting for it. There are no holy grails. The future will retain a degree of uncertainty, so you have to expect that losses or errors will happen. Don't look for the holy grail in technical indicators, because it doesn't exist. Instead, try to find ways to produce risk-efficient setups. When evaluating a technical strategy, many traders will often grade it based on the perceived winning percentage, which is suboptimal, because not only will that change, but there are other factors of importance, such as the size of the average win versus the size of the average loss. And just like we saw, even a 25% win rate can allow for a trader to produce a profitable strategy, provided that the money management was properly addressed. Again, we'll discuss that at length in our risk management module. Thank you for your time today, and I'll see you in part 3 for price action.